The bond bombshells, we're going to call it, truly remarkable. I want to put this into a little bit of context for you. A year and a half ago, the 10-year yield was 3.1%. In other words, one of the most widely traded market instruments in the world that is supposed to be known for stability has seen a 70% drop in yield in 18 months. This means that lending rates like mortgages and car loans may go down in cost. Yay, that's the good news. But could it also signal something maybe a little more sinister or worrisome? Let's bring in Jim Bianco of Bianco Research. Jim, welcome. Listen, truly remarkable move. Does the Fed know something that we don't?
No, the Fed knows nothing more than you or I know. Jay Powell's no more of a virologist than I am, and I know nothing about virology. But what they do know, and I'm going to push back in some of the earlier conversation and argue that the Fed did the right thing today. What they do know is the market priced in a rate cut. I argued it was going to happen yesterday, and that the market was demanding this rate cut because it saw problems. Today, which didn't really get widely reported, remember the old repo support we were talking about?
Yep.
Broke all the records today, broke the records from December 31st. The street demanded a record amount on bids submitted to the Fed on repo. They didn't get it because the Fed's been reducing the size, but there is something going on there, and that has also caused a lot of short-term rates starting yesterday to plunge, and with the market demanding those rate cuts, it was sensing the Fed was getting it. They had to move, and they had to move aggressively.
And what does that, again, the repo market, Jim, I know it's boring, it's a little bit, it's the internal plumbing of the market. We've talked about it on this program. It's confusing probably for people who even do it for a living. But what does that tell you about what Wall Street might be thinking?
Well, first of all, it's a surprise. We didn't expect to see it on March 3rd of anything else. But coming on the heels of what happened last week, it suggests that there is a bit of a liquidity problem beginning in the financial system. It's being satisfied by what the Fed is offering them, but they're demanding it, so that's worrisome. We'll have to see now tomorrow and the next day whether or not it continues, but that's one of the reasons that the Fed, I think, moved, and that's because the market was pricing it in. A quick word about pricing in. As of tonight, the market is pricing in another 50 basis points on March 18th. Down to 0.5%. And I would actually argue to you that if the market's pricing in 50 basis points or more for March 18th when we get there, they'll probably go all the way and just cut to zero in 2 weeks.
Jim,
they won't even waste that time to go in that inner step.
So I hear you on the repo, and we have been talking about it here for a long time. But so I'll push back and say, you know what, maybe if the Fed had come out and say, hey, there's a problematic bank out there or institution out there that's creating this problem. This is how we need to address it. These are the measures we're taking, instead of this is just the normal course of business or that nonsense, because it is nonsense. I think the market would have taken it a lot better than it currently is. What are your thoughts?
I agree with you totally. You know, when we look at these numbers every morning and you go, wow, look at that number, no color. Why is that number way up there? Why is that number larger than it was on December 31st? No color. It leaves you to fill in the gaps with your imagination on a day after the market had one of its worst weeks ever. So that doesn't help the situation. Then you add in that the market was pricing in 50 basis points for an intermediate move, and that's why I think the Fed had to do what they did. I understand your arguments about it didn't, they can't print a vaccine, they can't cause all those other things, but within their world and what they look at, this was the right move for them to do, and don't be surprised if you see an even more aggressive move in 2 weeks if the market still demands it like it is right now.
Jim Bianco. Jim, thank you very much. We do appreciate your time. All right. So, Tim, I mean, if Jim is right, we're going to the same level of Fed funds that we had pretty much at the peak of the financial crisis.
I just think that, and so Jim brings up, there's a lot of technical stuff that we're talking about here, folks. And again, back to the repo market. I mean, we came in, repo is at 180, which means someone bought at the entire Treasury curve. And so, yes, I get that. We need fiscal. We need fiscal to counter this. And obviously, fiscal gets to be incredibly political. You think the Fed is political? Obviously, fiscal policy gets into something. So it really just comes down to, unfortunately, we've created an environment where the Fed has the market has been pushing the Fed around now for years. And at some point, you get to this place. And I'm not sure that today's reaction was the right one. But we can leave that aside. what we're talking about for stocks, for companies, ultimately comes down to EPS. We're valuing companies based upon interest rates, but based upon EPS guidance and outlook, and that has changed dramatically. I don't think, despite the fact that we were tempered and the market's calling between 5 and 10% before all this came out, we're hearing from every CEO who can that this is a time when they're actually pulling back in the reins. EPS estimates have to come down dramatically.
So let me ask it this way, Dan. We got the monetary side today, and according to Jim and others, we're going to get that even more on March 18th when they're actually supposed to meet. If we get a fiscal package, like to Tim's point, maybe it's tax cuts, maybe it's literally direct cash payments to small businesses. Does that help the equity market?
Okay, it's socialism. Let's just socialize all the losses
No,
every
does
single
it
time.
help the equity market?
No, it doesn't. It didn't help it in 08, and it didn't help it in 01, and it's the time will help it. That's what's going to happen here. Time has to elapse, right? We need to work off some excesses. And again, I go back to they made their mistake in 2019 in July 31st when they cut rates for the first time in 10 years, and they did 3 25 basis point cuts, and then they started QE. That's what they're going to have to actually.
Well, they made their mistake back in 2012 or 13 when extraordinary Fed policy was never slowly taken out of the market.
Agreed on all that. Karen, let's go forward. Does it help equities if we get more?
Well, we're missing a giant piece of information, which is how the spread of the coronavirus evolves in the United States. Are we facing a tsunami? If that's the case, then, yeah, we've got to do more.